What is going on? We are here at another Tuesday Home Finance Hacks. I got to tell you, it's been a busy start to the week. I am actually just getting back home from vacation, but it was a great time, and so ready to jump right back into it. And this is actually this topic tonight is if you are not self-employed, this is going to be good information for you. If you are self-employed, you really want to listen up because this is going to be something that could be pivotal in your home buying journey. So what we are talking about is how much do you really want to, I guess you could say, extend your budget to purchase that home that's going to be a little bit more for you. So I'm going to give you some details on a situation that I'm actually working through right now. And so what it is there is a individual who's been pre-approved to purchase a home. However, as is the case with a lot of people, their budget is here and their desires are up here. You know, what they want, it far exceeds what they can actually qualify for. And so when it comes into that situation, as a self-employed buyer, typically the reason is because of tax write-offs. You're writing off, a lot of your income, and that's preventing you from being able to qualify for a lot. So the way that it works when you're self-employed is that whatever you make in income, a mortgage lender is going to subtract what you write off. Self-employed individuals typically have a lot of tax write-offs because that's how you can avoid paying a whole lot in taxes. So for example, if you make $100,000 in a year, but you write off $60,000 of it as business expenses, then a mortgage lender is only going to count $40,000 a year as your actual income. And that's going to, as you can imagine, drastically decrease how much you can actually qualify for when it comes time to purchase. A couple things that you can do to help remedy that. One of them obviously is getting a bank statement loan so that your tax returns aren't even going to be looked at and we're just looking at your bank statements. But a lot of people don't take that route because it does come with an increased interest rate. It comes with increased down payment as well. Generally, your down payment might be like 3 times as much as what it would be if you were just purchasing with a regular loan. So what I want to focus on is what a lot of people consider, and that is writing off less in taxes so that you can qualify for more in a home. So the way that that works is, again, we'll take that same $100,000 that you're making in a year, rather than writing off $60,000. Let's say they only write off $20,000. So now it shows $80,000 for their income. Well, you can purchase a lot more home with $80,000 of income as a self-employed individual than what you would be able to purchase if you were purchasing as, with $60,000 worth of write-offs, and now we can only use $40,000 worth of income. So as you can imagine, less write-offs gives you a higher purchase price as a self-employed home buyer. However, you are now going to need to pay more in taxes. You need to count the cost. What is it going to cost you to operate in this way, i.e., what is it costing you to claim less write-offs on your taxes, meaning you're going to pay more to the IRS just so you can purchase a home that is going to be of a higher purchase price, which is going to give you a higher loan amount, a higher mortgage payment, a higher tax bill, a higher insurance payment. These are the secondary and tertiary effects that a lot of people are not considering when they're just thinking, oh, I like the houses in that price range. That's the price range that I really want to be in. So I'm going to do whatever it takes to get there. Before you get into that, I'm going to do whatever it takes mode, think of what it's actually going to cost you to get there. Again, you're going to have to pay more in taxes if you have less write-offs because you want to qualify for more. And so when you're paying more in taxes, you are in a position where now you're obviously paying more to the government, but now you're about to pay more to a mortgage lender as well in the form of mortgage payments, because that mortgage payment is also tied to an interest rate. You're going to be paying more in interest. You might have the same interest rate. So let's say you have the same 6% interest rate on a $200,000 home as what you would on a $400,000 home. However, 6% interest rate on 200,000 is not as much interest as 6% on 400,000. You're paying more in interest. So your payments are going up. There's a lot of stuff that's increasing when you are purchasing that higher priced home. Like I mentioned, the homeowner's insurance is also increasing. That's something else that is going to be more, because to insure a $400,000 home is going to cost more than it would cost to insure a $250,000 home. Your property taxes generally are going to be higher because, let's say, all things being equal with the millage rate, you're going to pay more in taxes for a $400,000 home than what you would pay in taxes for a $250,000 home. So what I'm getting at is I want you to count all the costs of what is going to actually be costing you to get this higher priced home that you're wanting, and see if it's actually worth it. Because for many people, that first home that you're buying, that you're willing to sacrifice whatever you need to sacrifice, is not going to be your forever home. This is not going to be the home that you're going to be living in, maybe not even past 5 years or 7 years before you move on to the next home. So what is it that is costing you just to be in that particular home for the next 5 to 7 years, especially if you're going to be selling that home in 5 or 7 years? So it might not even be a home that you end up keeping as a rental property. It might be a home that you end up selling. So now you're paying more in taxes, more in insurance, more in property taxes, as well as to the IRS, and all for the next 5 to 7 years to live in this particular place. Consider, is there another place that could potentially provide you with everything that you need in a home? Not everything that you desire in a home, not everything that you want in a home, not everything that looks great on Zillow when you're window shopping, through your phone or on your laptop. But is there a more affordable solution that could provide you with everything that you need in a home? I mean, something that's big enough for you and your family. Or do you really need to sacrifice, hey, I need to give the IRS more money, and I need to give the lender more money, and I need to pay more in insurance so I can give the insurance company more money, and I need to give more to the county in property taxes so I can get this home that I really need to be in? When you think about it that way, it's the gears start turning a little bit different. And it's like, you know what, do I really need that $400,000 home? Or can I make the $250,000 or the $300,000 home work? That's some of the things that you want to be thinking about, because what I've seen is I've actually seen individuals who've gone back and amended previous tax returns in order to qualify for the home that they really want. So a mortgage lender is generally going to look at your last 2 years of tax returns. They're looking at the, let's say we're in August right now. So they will be looking at your tax returns for last year in 2024, and they're going to be looking at your tax returns from 2023 as well. They may also want to see a profit and loss statement for the current year, just to see how you're tracking along with your income for this current year. But they're going to want to see those last 2 years of tax returns. And if you had all of those write-offs in the previous years, and you're just now watching this episode or finding out from your mortgage lender that, oh, you had too many write-offs for us to qualify you for a higher purchase price, what I've seen is that people have actually gone back and amended past year's tax returns so that they could claim less in write-offs. Well, when you do that, what it does is now it creates a tax bill for you that's now due to the IRS. Because if in a past year you claim, using our example, $60,000 in write-offs, and now you're going to amend those returns and say, you know what, I'm amending that return, I only am going to claim $20,000 in write-offs. Well, that difference between the 60 and the 20, which is $40,000, well, now that's $40,000 that you're now going to be paying taxes on. That could be a pretty sizable tax bill. And if you don't have the money sitting in a bank account to be able to cover that sizable tax bill, that could end up putting you in a worse spot, because now that could have been money that you were going to be utilizing to purchase the home that you're looking to buy. But now you're going to be using that money to pay the IRS and taxes just to qualify for a higher priced home. But now, do you have the money for down payment, closing costs? Do you have the money for reserves if you need to have reserves to qualify for this loan? Do you have the money to make repairs if it's a home that needs to have some fixings done? You're digging into cash to give to the IRS to get a higher purchase price, which is actually going to cost you more money in the long run and in the near term as well. So these are some of the things that I want you to really play through in your mind is, how is it, I guess you could say, how are you doing with managing that budget and actually going through what is costing you to get that higher priced home, because I see so many people that are just laser focused on the house that they want and not the cost to get into that home, not the long term of how long am I actually going to be here, not the after I move out, what am I going to be doing with this home? And am I just selling it? Am I keeping it as a rental? Maybe you start looking at how would this home that I'm looking to buy serve me as a rental property? Is it in an area that I could easily rent? Is it an area that home prices are appreciating? So if I do sell it, I could potentially sell it for a profit and make a little money off of it. Maybe those are some of the things that you focus on rather than focusing on the desires of what you want in a home and doing anything to just get the house that you want, which may or may not be your forever home. Now, if it is something that you're looking at being your forever home, is something that, you know what, you're saying to yourself, I'm going to stay in this home for the next 15 years, 20 years, then by all means, go and be comfortable in the home that you really want. That's your prerogative. But one thing that I just want to recommend and stress is for you to consider the cost of doing this, by any means necessary method of purchasing a higher priced home, because it could be costing you a lot more in the long run than what you really want to spend. And you may be actually surprised the house that you don't like as much might end up being the house that you actually fall in love with, might be the house that's the best thing for you. I'll tell a personal story with a house that I purchased. The house that I should say my wife and I purchased, she was not thrilled about the home when we bought the home. She was not, head over heels. Oh, I love this house. I thought it was a beautiful house. But after living in the home for, a few months, she grew to love the house, and she really loves where we're at now. She loves the neighborhood. She loves the neighbors, and just the community, everything. So it's one of those things where, until you're actually living there, your perspective on where you're living and how you feel about it can change. That home that you're like, oh, I don't really like this house as much, could end up being the home that you end up loving. And the things that you don't think you like about it, could it be the very things that you end up making work for you. Also, last thing I want to say before I let you go is realize that how you purchase a home, there are things that you can always do to change it to suit more of what's going to work better for you. So maybe the lower priced home doesn't fit all of your needs, but there may be some potential for you to be able to renovate it rather than you doing by anything necessary what you need to do to get that home that's going to be $50,000 more. Maybe you cut that in half, and maybe you're only spending $20,000 or $25,000 to make the home that you already have work a little bit better for you. Maybe a little bit of remodeling, maybe a little bit of decorating, maybe just a little bit of, sacrificing your desires to actually become a homeowner, is something that will help put you in a better position rather than the I just need, I want, I desire. So that's what I have for you. Fridays, make sure you're tuning in. Jilly and I are bringing the heat for Greatest Asset Community Podcast, and be right back here next Tuesday, 7 p.m. Eastern Time. We're going to be going live on Home Finance Hacks. So till next time, take care